Hello everyone, in this presentation we will talk about the case of a study of Wood Creative Goods as our final project for the course Accounting for Managers. So, in this presentation we will make an analysis about critical information of the setup and operation of a new business, talking about depreciation, work in progress inventory, budget income statement, financial ratios, the CVP, the master budget, and the ethical considerations for the new business. As a little explanation of this case, Glenn purchased a small trailer on Facebook Marketplace. To his surprise, it came fully stocked with lots of woodworking equipment. Glenn is wondering what a good depreciation policy for the equipment might be, how to manage the inventory that he received, how a budget can help him to manage the business, and how the analysis of ratios, the CVP, and the master budget can help him to run his new company, and the ethical considerations to take in count.
Hello everyone, today I'm going to introduce the fixed asset depreciation in the case study. The small wood item equipment has different types of saw, each with different years of life and salvage value. We will use the straight line depreciation method, assuming that the fixed assets are consistently productive over time. So straight line depreciation works best because it is simple to use. Depreciable cost is the asset cost less the salvage value. The calculated annual depreciation is $1,450 and treated as fixed cost in the manufacturing overhead. As a recommendation, if the company will use asset with advanced technology that needs fast depreciation in the early years, like the computer equipment, we recommend double declining balance method will be more advisable. Thank you. Next, I will introduce the tracking of product costs in the inventory accounts. I will explain the flow of product costs between raw material, work in progress, and finished good inventory as shown in the diagram. The purchased raw material arrived, and it will be recorded in the material inventory account. Production requests for the material, so the issued material cost will be transferred from the material account to the work in progress account. Direct labor and also manufacturing overhead paid will also be recorded in the work in progress account. When finished good completed, this cost of finished good will be transferred from the work in progress to the finished good inventory account. When the finished goods are sold, these costs will be transferred from the finished good inventory to the income statement as the cost of goods sold. As recommendations, regular review of expenses and cost estimate to produce more accurate data for capital budget planning to enable better decision making. This is all I have to report. Thank you.
In the income statement budget, we get that the sales and expenses will grow during the 3 years, but keeping the sales and expenses inside the rate assigned, we can perceive winnings since year 1, with winnings beginning in 8,000 and rising to 12,000 in 3 years. This growth is centered in the continuous development of the sellings of projects and good items, keep efficient operation to keep expenses low. As a recommendation, I can assure you that a good control in the labor and material expenses is fundamental to achieve this goal. Also, develop a good and ethical use of the digital marketing and track the tendencies of the market wisely is a focal point to achieve this.
Hi everyone, I'm gonna take the financial ratios. On the account receivable turnover, we assume that the account receivable collection is being collected. Glenn Company converts average account receivable into cash 8 times better during this period. This means that there is a efficient collection process. Average collection period. This indicates that it takes Glenn about 45 days on average to collect receivables during the year. Glenn somehow needs to maintain or more look into it to more shorter in collection period. This will help him convert account receivable into cash to roll it up for business use. Thank you. Gross and profit margin. The gross margin is gradually decreasing from 29.34% in year 1 to 28.52% in year 3, meaning the cost of material and labor are revenue is being kept as profit. If this trend continues, it could suggest that production costs aren't being managed well, potentially hurting long-term profitability. For recommendation, he has to identify where the cost is going up, whether due to more expensive material or less efficient labor. To minimize waste, of course, he will also have to review his pricing in terms of sufficiency regarding whether it covers the production costs and when necessary, increase it to protect his margin but not so high that he loses customer. This might include improving the process of upgrading of equipment to help in cutting down the production costs. Last but not least, Glenn has to monitor the competition and find out how others manage to keep higher margins, showing probably more efficient method he can use. This will enable Glenn to sustain or even increase his gross margin and remain in business. On a profit margin, the profit margin is steadily increasing from 7.54 in year 1 to 9.28% in year 3, which is positive sign. This shows that despite the slight decline in gross margin, Glenn is managing to keep more of his sales as net income. These improvements suggest better control of expenses or growth in higher margin areas, which is helping boost profitability. And for recommendation, to continue this positive trend, Glenn should focus on controlling costs even further and maximizing efficiency. He could explore ways to reduce overhead, improve productivity, and maintain or slightly adjust pricing, keep his margins healthy. Staying on top of market trend and continue to optimize both large project and small wood product sales will help ensure long-term profitability. And that's all. Thank you. The ROA, or return of assets, shows a moderate upward trend from 20.46 to 22.19%. ROA is indicative of evidence that the company is being more efficient at getting better profit with better use of its asset. The hike should be indicative of a positive signal of Glenn's business that more income is generated for each dollar of asset held. ROE, or return of asset, depicts a downward trend. It falls from 27.39 to 25.14%. This would tend to indicate that the business is generating slightly lower return for equity shareholders compared to the prior year. A downward trending ROE may indicate that the business is becoming less effective in generating profit from its equity base. This could be due to increasing costs or other operational inefficiencies. Thank you.
Glenn's business is on a promising growth trajectory with expectation of 5% annual growth for large project and 20% for item sales. But for this growth to be sustainable, his marketing strategy must focus on more than just sales. Ethics should be at the core. By implementing an ethical marketing strategy, he can build long-term trust, loyalty, and success. Let's dive into some key principles that will guide this. First, let's talk about transparency. Customers need to trust the claim he makes about his product. That means being clear about their lifespan, materials, origin. Misleading information can lead to distrust or even legal problems, which we want to avoid. Next, there is customer privacy. In the digital age, respecting data privacy is essential. He will need to handle customer data responsibly and comply with laws like GDPR. Selling or exploiting data is a quick way to lose customer trust. So he should ensure their information is well protected. Lastly, sustainability. If he promotes his products as eco-friendly, the claims must be truthful. Misleading customers through greenwashing can damage their brand and lead to backlash. Sustainable practices should be part of his core values, ensuring his products align with what their customers care about. Moving Moving forward, accessibility is another crucial aspect, making his website and marketing material accessible by including alt text for image, captions for videos. Ensure him reaches a broader audience, including people with disabilities. This is not only help expand its market reaches but also reflect positively on its brand inclusiveness. Fair pricing is also vital. While his business may face financial pressure at times, it's important not to take advantage of high demand situations like crisis to hike up prices. Ethical pricing builds long-term customer trust and loyalty. To sum up Glenn's business, by focusing on transparency, privacy, sustainability, accessibility, and fair pricing, his marketing strategy will not only fuel his business growth but also build a strong reputation and lasting customer relationship. These ethical practices will set him apart and help ensure sustainable success.
Hi everyone, I'm Simone Gale and I'll be looking at the cost volume profit analysis or CVP analysis of Brooks Creative Woods. Now we know that the CVP analysis takes into consideration how profit is affected by cost and the volume within an organization. Looking at Brooks, we saw that he had projected to sell 70 units of indigenous flair at $100 for a revenue of $7,000. He had also projected fixed cost to be $3,000 and the per unit variable cost to be $25. This gave him a net operating income or profit of $2,250. With this information, we were able to calculate the break-even point, which tells us how many units or the value of those units that Brooks had to sell before he could recoup his initial investment. This brought us to $4,000 or 40 units of sale. Looking at this, we were able to calculate the margin of safety with this information because the break-even point being deducted from the budgeted or actual saved is the margin of safety. This gave us $3,000, so Brooks had a margin of safety of $3,000 before the business became unprofitable. This information can be displayed on a CVP graph, which gives us a more pictorial or a more visual experience of all this information, and it will be shown in the next slide. As previously stated, everything is displayed on the CVP graph. We can see the revenue line, we can see the total expenses line, we can see the fixed cost line, and the per unit. Now we can see that at 40 units, we break even or $4,000 of sale. We can also see that after the break-even point, which is 40 units, anything below that, we start to go in a loss and the business become unprofitable, and over 40 units, we started seeing gains and the business becomes profitable. All this information is displayed and is useful for people that want to see a visual representation of how the information presented in the case is actually displayed on a graph. Since Brooks wants to use this painting to pay homage to the Squamish people, there are a few ethical considerations that should be looked at. The first one is ensuring that Chino is respected while doing his art. The art should also be respected because it's paying homage to the Squamish people. This is their production, this would be fueled by their culture, and the culture should be shown respect. Second one is ensuring that Chino is acknowledged for his work. There are a lot of indigenous communities and creators that have not been acknowledged for their work, and this leads us to exploitation, ensuring that not only is he acknowledged, he is fairly compensated for any work that he produces. Finally, all this information can be used to spread cultural awareness of the Squamish people when conducting business.
Now, I will guide you through our in-depth analysis of merger budget. Our comprehensive master budget follows a basic financial framework that includes the following key components in its development sequence: sales, production, direct material, direct labor, manufacturing overhead, sales and administrative expenses, as the income statement budget. Together, each of these elements form the backbone of our master budget. Sales figures notably reflect the same growth over the 3 years. Production materials and labor also increased slower than the sales, are seen from our expense table. This gives us a net income between 7 and 10% of the total sales as a healthy profit margin. Our calculations and assumptions are detailed in the attached Excel spreadsheet with the report and show how the business will be potentially profitable if accounts are well managed and sales and expenses targets are achieved. In this analysis would indicate that the company may be profitable from year 1. Though the budget might need modification according to the prevailing market conditions and company requirements, we strongly feel that you are equipped with sufficient tools and procedures to accomplish the result forecasted for the next 3 years successfully. In the same vein, we recommend supporting the continuance of growth at budget percentage above. At the same time, attempt to hold expenses at estimated levels or below, with the ability to grow overall cost by up to 5% if necessary. This strategy will ensure that the company remains independent and continuously yields at least net income. If the result of year 1 turned out to be as expected, pursuing the same strategy for another year will be worth considering, and it's essential to verify whether the market is stable and how much autonomy this company enjoys before further investment are pursued. Lastly, I encourage you to take a closer look at the Excel documents where you will find the calculation and assumptions behind our approach to budgeting. Thanks to you for your attention and look forward to discuss how we can work together to achieve your financial goals.